We're going to continue working in Chapter 3 and looking at the options for the parent to record the investment account using either the cost method, simple equity, or sophisticated equity. And we're going to use 3 exercises to demonstrate more of how that is incorporated into the worksheet. So we're going to start with exercise 3.4, which is a continuation of exercise 3, so you need to read in your text the information for both of those. And you see that the price paid in exercise 3 for the acquisition was $272,000. For that, they acquired an 80% interest. So the ownership interest is the 80%. And that's what calculates our implied company value as we did in Chapter 2, splitting it then between the parent and the NCI. Now, when we're doing the DDE, that initial, you'll notice that I have over on the side the date of acquisition, because that's different than the date of consolidation. This is where Chapter 3 builds from Chapter 2. And to get the information at that date, we go back to the original balance sheet in exercise 3. And there was common stock of 100, no paid-in capital, and 150 in retained earnings. So that gives us total equity of 250. And we split that between the parent and the sub using those percentage relationships, and determine that our total excess is 90,000, again split between the parent and the non-controlling interest in the subsidiary. And this again, just like we have done before, will become the basis of our D entry. The excess amount is allocated based on the information given. Fixed assets were undervalued by 60,000, and the remaining 30 then is goodwill. So that should be somewhat review our basic DDE. The date of actual consolidation that you see down below with the worksheet is 12/31/12, 2 whole years after the acquisition. So we have to account for that passage of time, and this is new because we didn't have that passage of time in Chapter 2. Because the worksheet is not part of either general ledger, we have to account for the things that would have been incorporated into permanent accounts by keeping track of them on the worksheet. One of those is obviously going to be the fixed asset difference of 60,000. From the information, you'll see that it was a 10-year life, and therefore we're going to amortize or depreciate each year $6,000. Well, 6,000 is for 2012, but I also had 6,000 in 2011. This is where that lack of general ledger comes into play. So I'm actually going to have to account for 12,000 in my A entry, which will be a new entry, amortizing those excesses. Now you'll notice I've been saying amortization. Technically, the parent who's preparing these financial statements does not have title to that asset. So while you can put it on the worksheet as depreciation and think of it as depreciation, theoretically, based on accounting concepts, it's a right to the asset, not the actual title, which is why you'll see that we call it amortization in a number of places. So don't let you hang that up. It's the same thing. It's a technical difference in terms of terminology. So now we're ready to come down and do our elimination entries. Under this one, we are doing simple equity. So under simple equity, remember, the parent has continually recorded the income and dividends of the subsidiary that have affected their underlying retained earnings, and therefore the parent's investment account. You'll notice in the parent's trial balance here, there is subsidiary income of 12,000, because under that simple equity, they're recording the ongoing effect of that investment like we saw in problem 3.1. So under this simple equity method, we have the CY1 and CY2 entries. CY1 is reversing that out because we're going to pick up the details, so we reverse out that amount, and we also reverse out any dividends. You'll notice in this case that the subsidiary declared dividends of 10,000. we're entitled to 80% of that. So we're going to eliminate 80% of that from our investment account because that's where it was recorded. But if you remember, the other half of that entry was cash. Well, the cash remains cash, but we have to account for the fact that there's those dividends on the sub, so we're going to take it and offset it against those dividends. So that's our CY1 and CY2 entry under simple equity. Then our common stock we're going to eliminate is based on what's actually on the trial balance of the subsidiary because it may have changed since acquisition. You'll notice the common stock hasn't, but retained earnings has, and I pick up those revised amounts and eliminate it against the investment account because that's where we've been recording it. The D entry again comes back from the DDE. This line is our D entry, so that's what we're going to pick up down below. So we had fixed assets of 60, adjustment to goodwill of 30. The amount that was related to the parent is the 72 and the 18 to NCI from the entry. Now our new entry here is the A entry. The depreciation expense is the current year. That's the $6,000 for this year. But we saw in our schedule up above that we have 2 years to account for, and our total amount in accumulated should be 12. So our total accumulated will be 12,000. And you'll notice that there's 2 lines here for the prior year. This is because 80% of it belongs to the parent of that depreciation, while the other 20% belongs to that NCI, and that NCI piece, or non-controlling interest, stays in the subsidiary account. So there's our entries, and we are then ready to put those in to the worksheet. So we'll put in our CY1 entry here. And you'll notice then that will eliminate that account because we don't want to double count anything. And again, on the worksheet, I'm going to put in my credits as negative amounts to make the math work. Now we're going to do our CY2 entry. And you'll notice here that now the dividends that will come across are the dividends that were paid only to the NCI. Then I need to eliminate my subsidiary equity, and I just caught something that I did not do correctly when I did the entry because I forgot. Remember that we always have to use the percentage that was acquired, so we need to go back and adjust that for the percentage acquired, and you'll notice that it wouldn't have worked in the investment account. We would have caught our error. So we're going to take the 80,000 and we're going to take the 136, and the remaining portion when we carry these numbers across will become the NCI, and then the rest is against the investment account. So that's our EL entry. Now we just have our D and A entries left. So D is to fixed assets, and we also had goodwill. Then we need to eliminate against the investment and against NCI, which we're going to put down here with subsidiary equity because that's where it's going to ultimately go, is with those. Then our A entry, you can create a separate line item if you want for depreciation expense. I'm going to just put it right to the general expenses here. And then we have our accumulated still that we need to record on that line item. Then you're ready to complete the worksheet and carry it across. Now remember, with the balance sheet, all of these items simply come across to the balance sheet column. So you can sum those across and then check them. So our current assets looks okay. Remember, our investment account may need some additional entries in the formula to make it work out, and then we'll eliminate those two lines that we've now corrected. So we do have our investment correct because it's zeroed out. Our depreciable assets, including the step up, our depreciation, including the amortization for the excess, our goodwill, and our current liabilities. Now we're down to the equity of the subsidiary. And we said already that that equity anything that belongs to the NCI. So you'll notice I carry those across to the NCI account and then have to adjust for this one additional amortization entry. So that's where those go. My common stock comes across to the consolidated balance sheet. The retained earnings of the parent we're going to take across to its separate column. And I encourage you to get used to this because we're going to continue to expand and build on entries. So it's good practice to do it when it seems pretty simplistic because it'll help you as we go forward. Income statement, I take across to the income statement. You notice the subsidiary here, that's totally zeroed out. All I have left is the dividends declared. And those, again, I'm going to carry across to the NCI column because that's where they belong. Now I want my subtotals in here because we're going to add another piece by adding a distribution. We have to distribute between the parent and the NCI, and we're going to show you how that works. So I'm just putting in my subtotals here. I'm just going to carry that across. And it looks like I did forget to put one of my entries in as a credit. So now you'll see that my debits and credits equal. That's obviously what we want. This $49,000, how am I going to split that between the parent and the sub? That's where we're going to go up and use what's called income distribution accounts. So this is my check figure, I need to split $49,000 somehow between the subsidiary and the parent. You start with internally generated net income coming right from their trial balance. So for the sub, it's their sales less expenses. Their internally generated income was 15. We do the same for the parent. Their income statement accounts, sales less expenses, gives them 40,000. Now if I look at the worksheet, specifically in the income statement area, what I want to do is any adjusting entries that are in here on the worksheet have to be part of somebody's income because that was part of the income statement. So it has to belong to one of the parties, and that's where these income distributions come in handy. Right now we only have 6,000, not as hard as some of them that we're going to get in coming chapters, but as I said, it's good practice to start doing this early. So this 6,000 belongs ultimately to the subsidiary because it's amortization of their items. So we're going to put it in their income distribution and get a revised total of the subsidiary of 9,000. Of that 9,000, 20% is NCI. The other 80% belongs to the parent. And we'll put that down on the parent's books. And therefore, the parent gets a total distribution of 47.2. And I'm going to do a check figure out here again. The 47.2 plus what goes to the NCI should equal, which it does, my check figure from the worksheet. And that's what we're going to do with income distribution schedules. And we'll continue to do them so you'll see plenty of examples. So now that 49,000, I'm going to come down here and take and distribute what I just calculated. I'm going to distribute 1,800 to the subsidiary and 47.2 to the parent, so that this in essence zeroes it out. All I'm taking is shifting it from the income statement like a closing entry in a general ledger, shifting it to the NCI and retained earnings. Now that NCI total ultimately is reported in the equity section on our consolidated balance sheet. So we're going to shift that as well and take that and put it into the consolidated balance sheet. And my last thing I have to close or shift over in column is, remember, the statement of retained earnings then goes to the balance sheet. Well, I'm going to take my retained earnings and move it to the balance sheet. So when I carry this over, then the balance sheet zeroes out like it should, because assets equal liability and owner's equity and balance. And that completes our first worksheet.